Hi everyone, today I'm going to share with you how you can screen for value stocks, companies that you might want to own in the long run, right? They'll continue to grow year after year. So before I do that, I just want to introduce myself. My name is Kenny, lead analyst at the Fifth Person. At the Fifth Person, we want to help you become a better investor by sharing with you useful tips that you can sharpen your skills. So today I'm on the topic of screening stocks, so I'll share with you the websites that you could use and as well as the financial metrics that you could use to sieve out these potential companies. And of course, in the past, Warren Buffett have to go through pages and pages of the S&P 500 Moody's manual, but thankfully for technology, you don't have to do that. You can just go to the website and just enter the criteria you want, the financial metrics and ratios that you are looking for, and they will come up with a list. Without further ado, let me show you how to screen for these stocks. Hello everyone, welcome back to my browser. So right now I'm going to take you through the process of how I actually screen for stocks. So the screener that I like to use, which is free for all, is called FINVIZ. And as you entered FINVIZ, you can see on the top left hand corner there's this screener button. You just click onto it, and since I am a value investor, fundamental is everything to me, I will hit on the fundamental tab. And with regards to financial ratios, I just want to share with you that there's no right or wrong with regards to financial metrics that I'm using. You can use any financial metrics the way you like it or how stringent you want it to be, depending on your taste or what you're looking for. So in my case, I like to look at return on equity, companies that has it over 15%. So right here, it hit 15%. I also like companies that has a current ratio of over 1, and it has a long-term debt to equity of under 5. So I don't like companies that are pretty much leveraged or heavily leveraged, and I like to have a net profit margin of over 10%. So let me explain a little bit about the financial metrics, why I picked this financial metrics. So first of all, if you're new to investing, I always think that you can be as stringent as possible because you want to filter the best companies, right? Companies that has low debt, that is highly profitable, and you want companies that not as capital and intensive, so they tend to have higher net profit margin. But at the same time, you need to understand that companies that has higher debt doesn't mean that they are bad companies. They could have borrowed more money to acquire companies that could possibly add more revenue to them in the future, right? And at the same time, doesn't mean companies with lower net profit margin is not good. There are companies like Costco, that are grocery companies that are growing really quickly, but they have very low net profit margin, but doesn't mean that they are a bad company. So aside from that, once you screen for all these companies, you can maybe start with companies with large market cap. So you can screen by size. So as you can see right here, there's Alphabet here. Alphabet is the largest. I'm sure we all know Alphabet, right? Google, and they're the largest search engine in the world actually. So with Google market cap, so once you filter for the stock, this is just step one, and after that you really have to look at the financial performance of the company. As you can see, when we filter for these stocks, we just filter for that single year, right? It's definitely not a range, right? You're not looking for the past 10 years. So current ratio, on certain years it could be over 1, certain years it could be under 1. What we're looking out here is consistency, and to do that you have to look at the company's financials. So right here, for US companies, you can either use gurufocus.com, of course you have to subscribe to it, or Morningstar. So with Morningstar, once you subscribe to it, you gain access to the financial information for the past 10 years or even up to 30 years if you want to. So you can see here, revenue is growing year after year. For just to save time, I have actually exported all the information that we need onto an Excel sheet. So as you can see here, these are the few metrics that we want to look out for. Revenue, we want to make sure that they're consistently profitable, right? They're growing year after year, very steady. Net profit as well. Net margin, we're looking for anything that's above 10%. You can see that, right? For the past 10 years, it's over 10%. Return on equity, you see every year is also above 15%, right? See over here. except for 2017. So like I said before, right, when you screen for stocks on FINVIZ, you're actually screening for 2019 only. As you can see, 2019 hit all the criteria that we wanted. And of course, you see current ratio every year is above 1, a long-term debt to equity below 50%. And of course, if you want to put in more work, you can look at their operating cash flow, right? You want companies that they are able to generate a lot of cash year after year, and that cash is king, is the lifeline of the company, right? They can reinvest the money, and you know whether they are asset light or not, right? Some companies, they have a lot of net profits but no cash, no operating cash flow to show for. So okay, so Alphabet passed our criteria. And then what you can do is go on to the next tab. You can see it's nothing fancy. I only created 2 columns over here, passed and fail. It's very important. So you put, like I put here, Alphabet, and you know that you look through this company, and also if a certain companies failed your screen, you also want to put it here, because you just don't want to spend time looking at a company twice, since you look at it before, so you know which one has already passed, which one hasn't, so you just keep it as that. So it's very good. In the long run, it's actually better for you because you're well aware of all the companies that are good and bad. You can quickly tell, okay, this is bad, because you've seen it, it's on your list, and sometimes you can review them again and again, so you have an idea. So after this, I'll go back to the screener FINVIZ just to show you that you could also possibly screen for bad stocks. Doesn't mean every stock on this screen is good. So let's look for a company that's not very good. And you see here, we will take a look at Barrick Gold Corp. Barrick Gold Corporation is basically a gold mining company based in Canada. And with that, I have of course have tabulated their financial information on this Excel. So let me scroll down. And first of all, I just want to show you why it passed the screen. As you look at Barrick Gold Corp, you can see 2019, their net margin is above 10%. Their return on equity is above 15%. What we screen for, current ratio is over 1. And long-term debt to equity is under 50%. So it basically passed our criteria. But whether is it a good company or not, when you look at their performance for the past 10 years, you can see that their revenue is rather choppy. You see in 2010, 2011, they're doing well, and 2012 as well, it was decent. Then from then on, it fell off and it started doing badly, and it came back up again. So this company is most probably a cyclical company, right? When the economy go down or the prices of gold go down, it will affect them. And net profit as well, you can see on certain years they're profitable, certain years they are not, as well as their net margin, ROE also. So actually, a quick way that I'll do this is I'll just look at the revenue and net profit very quickly. I just scan from left to right. Okay, maybe if they are losing money for 1 year, is okay, as long as it is consistent most of the time. So 1 year they are losing money, for example, if it's Google, 1 year if they are losing money is due to litigation or some sort of issue, one-off issue, it's okay. You can just leave it and look into the annual reports to see if it's really a big issue. If not, with most companies, you just have to look at these 2 metrics, and if it's choppy, you can just discard it. So with Barrick Gold Corp, all you gotta do is just do. So that's basically it. Very simple and easy to screen for stocks. There's no substitute for hard work. All you got to do is just simply screen for them, look through their financial performance, whether they're consistent over the past 10 years, and once it passed, you put on your list to show that it passed, and as well as companies that has failed. And after that, you dig into their annual reports, read their annual reports, determine the intrinsic value of the company, and make sure you invest with the margin of safety, right? Don't just blindly invest because it just passed your screen. So I just want to remind you so that you go through the procedure. This is just step 1. So once you're done with this, you're good to go. I hope you learned something useful about screening for stocks. Stocks that are very attractive, and of course, doesn't mean that it's attractive now, you should own it. You have to wait till it's undervalued, have a margin of safety before investing in the company. And of course, if you find this video useful and you think that your friends are also trying to find ways how they could go about screening for these types of companies, feel free to share it with your friends and hit the like button. At least we know what we're doing here is well worth the effort. And of course, if you like videos like this, remember to subscribe by hitting the subscribe button. And of course, if there's any new videos coming up in the future, you'll be the first to be notified. So thank you for your time, thank you for watching this video, and I'll see you in the next one.